Welcome to BetterBooks with Kathy Houston. This is our auto loan section. When people add auto loans to their books, they can sometimes get really confused. So I've created this section to go over the basics on how to add auto loans to your books. Auto loans are the most common type of long-term liabilities for small businesses. This type of loan involves the fixed asset account and the long-term liability account. To post this transaction, we need the bill of sale and the finance agreement. For this example, we will assume that the total amount financed is also the amount that is on the sales agreement, meaning that there was not a trade-in or any amount of cash put down on the purchase. For this example, we purchased a 2021 F-250 vehicle for $52,500 and financed it through Ford Motor Credit. We're going to add vehicles to your chart of accounts as a fixed asset account, and we're going to add Ford Motor Credit loan to your chart of accounts as a long-term liability. And this is the general journal entry here on the screen. We're going to debit vehicles for $52,500. We're going to credit Ford Motor Credit loan for $52,500. The amount financed on the finance agreement that the red arrow is pointing to is the amount that you want to use on your balance sheet. Payments for the auto loan should be posted to the Ford Motor Credit loan liability account. Only the interest on the loan will post to the income statement and your profit and loss. This shows an example of the vehicle amortization using a workbook already created in Excel. It creates the amortization so that you can separate out the principal and interest of the loan. Only the interest part of the payment is an expense to the business. The vehicle is already being expensed by using depreciation. This shows you the check for the payment and how it is posted. Note that the payments do not change the amount listed under fixed assets. Fixed assets are always carried at purchase or fair market value and only change with the purchase or sale of an asset. So what if you're already paying for the vehicle personally and you want to bring it into your business and let the business start making the payments? To do this, we need the current loan balance, the interest rate, the amount of the payment, and how many payments are left in the loan. Then you'll use the following general journal entry. Using this general journal entry, you will see that the vehicle is carried at the original purchase price, the loan balance is posted at the current loan balance, and the difference is shareholder contribution. So what if you've been posting all of your payments to the loan balance and not separating out the interest? This will make your loan balance on your books less than the true balance, because remember, only principal lowers the balance. Look up your current balance on your statement and adjust your balance on your books to equal your statement. The difference will be coded to interest expense. Make sure that you create your amortization spreadsheet so that you can begin to code the payments correctly. Do you have to look up the amortization every month? No, you can make adjustments quarterly or yearly if you like. If you don't want to use the amortization spreadsheet at all, you can just adjust your balance at year end to match your statement balance using this same general journal entry. On slide 3, I based my example on financing the entire vehicle with no down payment and no trade-in. So I want to share the two general journal entries for those two items. This is the general journal entry for a down payment. If the down payment comes from the business bank, it looks like this. If you personally made the down payment instead of using your business banking account, then you'll credit shareholder contributions. This is the general journal entry for a trade-in, and it's much more complicated. So let's break it down. We have an old vehicle on our books that originally cost $32,500, and we had accumulated depreciation of $11,000 for that vehicle. So use this general journal entry and fill in the easy numbers first. We know the new vehicle cost $52,500 and the amount financed is $30,000. The trade-in value is $22,500, so we have to take the old automobile completely off the books. So the remaining original value has to be subtracted, and accumulated depreciation needs to be cleared out for the truck's value. So the difference in the debit and the credit side is $1,000, and that's our plug number. So let's look at the calculation so that makes sense. If the vehicle was originally $32,500 and we subtract out accumulated depreciation of $11,000, then we had the vehicle on our books at $21,500, but yet we received $22,500 for the vehicle as a trade-in, so that's a gain of $1,000. Congratulations on finishing the auto loan section of the Advanced BetterBooks course. I hope this helped you to clear up some errors you're making in your books when posting your auto loan payments. See you in the next training.